Ever wondered how the Federal Reserve's rate decision impacts your bank account, CDs, loans, and credit cards? Well, the Federal Reserve, also known as the Fed, recently decided to hold interest rates unchanged. This decision keeps the target range for the federal funds rate, the short-term rate banks use to borrow from each other, at 5.25% to 5.5%. The federal funds rate is a key tool the Fed uses to influence borrowing costs and saving rates. When the Federal Reserve changes this rate, it reverberates throughout the financial world, affecting everything from the interest on your savings account to the cost of your mortgage. This recent decision to hold rates steady indicates the Fed believes it's making headway in its ongoing battle against inflation, which peaked at 9.1% in June 2022. However, the fight isn't over yet. The Federal Reserve's decision to hold rates indicates a belief that they are making progress in the fight against inflation, but work remains. So, what does the Federal Reserve's rate decision mean for you and your finances? Well, the impact is broad and multifaceted. When it comes to bank accounts and certificates of deposit, or CDs, a hold on interest rates means that the returns on these savings instruments remain steady. For loans and credit cards, it means that the cost of borrowing isn't going up in the near term. But there's more. The Federal Reserve's decisions on interest rates are a tool to manage the economy. When inflation is high, like it was in June of 2022, the Fed may raise interest rates to slow down spending and bring prices back in line. Conversely, in times of economic downturn, the Fed may lower rates to stimulate spending and kickstart a recovery. So in essence, the Fed's interest rate decisions are a kind of monetary thermostat, helping to keep the economy's temperature just right. The Federal Reserve's decisions on interest rates play a significant role in the health of the economy and your personal finances. What might the future hold for the Federal Reserve's rate decision? As we look ahead, the Fed's statements shed some light on their plans for interest rates. On May 1st, the Federal Open Market Committee expressed that while inflation has somewhat eased, it still remains elevated. They also noted a lack of progress towards their 2% inflation objective in recent months. This is critical because the Fed is essentially saying they need to see more confidence in the inflation rate moving closer to their 2% target before they'd consider a rate cut. They're not playing guessing games here. They're waiting for clear signs of stable, manageable inflation before making their next move. This approach is indicative of the Fed's cautious and measured stance in managing the economy. They're focused on maintaining balance, avoiding drastic changes that could potentially destabilize the financial markets. Keep an eye on the Federal Reserve's rate decisions. They could have a significant impact on your financial future.